Today, we're diving into the high-stakes, secretive, and often controversial world of private equity. But don't worry, we'll make it simple, fun, and even answer the question of if private equity firms are good or evil or somewhere in between. So what exactly is private equity? Let's start with the basics. Private equity, or PE, is all about investing in companies. But unlike buying shares of companies on the stock market, these investments happen behind closed doors, away from the public eye. Here's how it works. Imagine you own a small bakery. Your business is doing well, but you want to expand. Open more stores, buy better equipment, maybe start selling your famous muffins online. The problem? You don't have enough money to do it. That's where a private equity firm could come in. A private equity firm is like a really rich business partner. They offer you a big pile of money to help your business grow. In exchange, they get a slice of your company. And by slice, I mean a big slice, an ownership control-sized slice. But here's the catch. They're not just giving you money because they like your muffins despite how awesome they are. They want to make a lot more money back than they gave you. Their goal is to grow your company as fast as possible, make it more valuable, and then sell their slice for a huge profit. Let's break down the typical private equity transaction timeline. This usually happens in three main stages. 1. Acquisition. 2. Improvement. And 3. Exit. First up, acquisition. The private equity firm finds a company they believe has potential. This could be a bakery, a tech startup, or even an old-school manufacturing plant. The possibilities are essentially endless. They buy a significant chunk of the company, sometimes using their own money, but most often borrowing a lot from banks. The private equity firm will use the assets of the acquired company as collateral for the loan and the cash flow of the company to pay back the loan. This is called a leveraged buyout, or LBO. Think of it like buying a house. When you buy a home, you put down some cash, but most of the purchase amount that is paid to the seller comes from a mortgage. The hope is that the house will go up in value, so when you decide to sell it, you make a nice profit. That's essentially the same thing that private equity firms do with businesses. Let's illustrate with a simplified example. Imagine a PE firm buys a company for $100 million. They put down $30 million of their own money and borrow $70 million from a bank. Over the next 5 years, they work hard to improve the company's operations, boost revenue, and reduce costs. Now, if the company's value has grown to $200 million, the private equity firm can sell it, pay back the $70 million loan, and keep the remaining $130 million. That's a $100 million profit on their initial $30 million investment. But what if things don't go as planned? Suppose the company's value drops to $80 million instead. After selling the company and paying back the loan, they're left with only $10 million. That means they lost $20 million on their original investment of $30 million. Yikes! This shows how leveraged buyouts can run the gambit from massive profits or painful losses, depending on how things turn out. Next is the improvement stage. This is where things get interesting. Once they own the company, private equity firms roll up their sleeves and get to work. Their job is to increase the company's value as quickly as possible. How? Well, they use several strategies. 1. Cutting costs. Maybe the company has too many expenses. They might streamline operations or reduce staff to trim costs. 2. Boosting revenue. They could improve marketing, launch new products, adjust pricing, or expand into new markets. 3. Mergers and acquisitions. Sometimes they'll merge the company with another one to create a larger, more powerful business. Of course, this stage isn't always smooth sailing. Cutting costs can mean layoffs, and aggressive organizational changes don't always sit well with employees or customers. That's one reason private equity has a bit of a mixed reputation. Finally, we have the exit. After a few years, usually 3 to 7, the private equity firm is ready to cash out. They want to sell their ownership stake for way more than they paid. They might 1. Sell the company to another firm or a bigger competitor. 2. Take the company public by listing it on the stock exchange. 3. sell their stake back to the original owners or another investor. When it all works out, everyone's happy. The private equity firm makes a fortune, the company might be stronger, and sometimes employees get bonuses. But when it doesn't work out, well, let's just say there have been some spectacular failures in private equity history. Remember Toys R Us? Yeah, that's a story for another video. So why do private equity firms do all this? Simple, huge profits. Private equity firms typically aim to at least double or triple their investment, and the people running these firms, called partners, can earn millions, sometimes billions, if things go well. But it's not just all about money. Private equity also plays a big role in the economy. They can help struggling companies survive, create new jobs, and push innovation. At the same time, critics argue that private equity firms can prioritize profits over people and communities, sometimes leading to massive job cuts or bankruptcies. All right, quick recap. Private equity firms buy companies, make them better, hopefully, and sell them for a profit. They use strategies like cutting costs, boosting revenue, and sometimes merging with other companies. When it works, it can be great for everyone involved. When it doesn't, well, things can get messy. That brings us to the big question. Are private equity firms good, evil, or something in between? Well, the answer depends upon whom you ask and on which firm or deal you're talking about. Private equity firms have helped rescue struggling businesses, injected much-needed capital, and created jobs. Some companies owe their survival to private equity interventions. On the flip side, there are plenty of stories about private equity firms gutting companies, laying off employees, and saddling businesses with unsustainable debt, leading to collapse. So, are they knights in shining armor or corporate villains twirling their metaphorical mustaches? Honestly, they're neither. They're investors. Their goal is to make money. Whether they end up as heroes or villains depends on how they achieve those returns. At the end of the day, private equity is just a tool like a hammer. In the right hands, a hammer builds houses. In the wrong hands, it breaks things. Private equity can build businesses up or break them down. It's not inherently good or evil. It's how people wield it that determines the outcome. So whether you see private equity as a force for good or evil probably says more about how you view capitalism in general. One thing's for sure, private equity will continue to shape industries and economies, for better or worse. Remember, knowledge is like private equity. If you invest in it wisely, the returns could be huge. If you enjoyed this video, check out this one, or leave a comment below telling us which financial or business topic that you would like us to cover next.